This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collecting trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode takes us inside the world of wealth from the perspective of one of the industry's largest alternative asset managers that has made the wealth channel core to its firm's DNA from the beginning. We are joined by Sean Connor, the president and CEO, Global Private Wealth at Blue Owl Capital, a firm with almost $300 billion in AUM. Sean highlighted a number of key insights for navigating and working with the wealth channel as he shared lessons learned from building a successful private wealth business at a large alternative asset manager. Sean is responsible for bringing the breadth of the Blue Owl investment platform to the global private wealth market. He's at the forefront of Blue Owl's private wealth initiatives globally and oversees fund formation, product structure innovation, capital raising, and client servicing. He also oversees business development, marketing, and operations for private wealth at the firm. Prior to his current role, Sean was one of the first employees at Owl Rock, now the direct lending division of Blue Owl, and was responsible for building out the private wealth business. Prior to joining Blue Owl and Owl Rock, Sean served as a managing director of Scion Investment Management for over 10 years. Sean was a member of Scion's investment committee and was responsible for all aspects of Scion's business, including originating, underwriting, and negotiating corporate finance transactions globally. In 2020, Sean was recognized by Private Debt Investor as one of the industry's rising stars. Sean and I had a fascinating conversation about what it's like to work with the wealth channel. We discussed the biggest drivers of AUM growth for Blue Owl and how the wealth channel has been a major part of the firm's story of scale, lessons learned from growing and scaling a private wealth business in the US and internationally, the differences between the wealth channel a few years ago and the wealth channel today, what the wealth channel wants and needs from its alternative asset management partners, why Blue Owl focuses on investing in megatrends like AI, digital infrastructure, and private credit, and the opportunity in the 401k and retirement channels. Thanks, Sean, for coming on the Altco's Mainstream podcast to share your expertise and wisdom on private markets and private wealth.
We're going mainstream.
Sean, welcome to the Altco's Mainstream podcast.
Great to be back.
Oh, yeah, I should say welcome back.
Yeah,
And
thank you.
in the time that you were last on, I was looking back, March of 24, you were at 160 billion of AUM. Today, you're close to 300 billion of AUM. I would love to just start there and really unpack what have been the growth drivers of the past few years.
Yeah. My guess is our growth pales in comparison to your subscriber growth, by the way, of those 2 years. I'm curious if you have those off the top of your head. But look, I think we're obviously very excited about the growth of the business. Growth is really the output, in my opinion, though, of the inputs. And I think it's been a really big focus on a couple things. I think the main one would be diversification within the business. So if you look back, and I would extend it back 3 years ago, that's really when we started this journey. The business started as a direct lending was the vast majority of our focus. And then you fast forward today, direct lending is a giant part of our business. But this year, for example, we're just wrapping up in 2025. Direct lending represents on the evergreen side only about a little over half of our flows. 3 years ago, that was 80% of our flows, right? And our flows are up 2.5 times over the last 3 years. So our flows have grown meaningfully, but have diversified. So we've added things like asset-based finance in the private credit space. We've added things like triple net lease in our real assets business, and then more recently, our digital infrastructure in the real assets business. So I think it's been diversifying the business, but also diversifying it in the way that we really operate, which is like, how can we bring capabilities that our clients don't have access to, but would add real value? And how can we really bring innovative products to them and innovative solutions to the market? So I think we've demonstrated over the last 2 to 3 years our ability to find innovative solutions in big TAMs that add real value to the client. And then we've executed and brought that. In addition to that, aside from strategy, I think it's an indication of just the market opportunity for wealth writ large. So the U.S. continues to be the biggest market, but still, lowly penetrated relative to, what the opportunity set could be. And then the international market, which probably started a couple years behind, is increasingly focused on it. So we've seen growth in our U.S. market. We've seen expansion internationally on top of diversifying the investment strategy. So all of those have really contributed to the growth of the wealth business in Blue Owl. And then the same thing institutionally, right? So it's not all wealth is double the AUM. We've added those capabilities and we've tailored them to the institutional community, which is also resonated.
When I hear you talk about a lot of these things, there's a few elements that come to mind that, to me, kind of get to how do you balance expanding, serving different clients, making sure you're educating, but also keeping the brand essence the same. How have you thought about the brand essence of Blue Owl and how you expand into these different areas and increase the footprint while maintaining who you are as a firm?
One of the main things I think about every day when I wake up and when I go to bed. So it is big picture. I think what we're really trying to do, and we've been consistent about this, is we're not trying to be all things to all people. Like, that's really not who we are. We're really trying to be very deliberate in areas that we think are big secular trends, big addressable markets. They have the attributes we look for, which are usually income and downside protection, where we can be a leader. Maybe not the leader, but a leader. So if you look at the business, half fits in private credit. Like, we're decidedly one of the leaders in that space. In our real assets business, we are the largest player in triple net lease, and we are one of the largest players in the digital infrastructure space. We're the largest in our GP strategic capital business. So it's actually not that complicated. There's only a small handful of things we do, but we do them very deeply, and we try to do them at a high level of excellence. And so if you stick with that, that helps. And so that's kind of our bar, is if we're doing things, we want to do them in a way that we are a market leader and then can really have all the focus of the leadership of the team to do that. And then it's about getting your people to think that way, right? So it obviously gets harder as you add new capabilities and you grow internationally. And so a lot of that is then just culture, right? So like a culture of focus, a culture of working together to accomplish those goals. The investor strategy is not competing against each other. They're actually deliberately set up in a way to actually help each other. And we're seeing that in some of the megatrends. And so I think it's that focus, that trying not to be all things to all people, and then tying that together with a culture that is, behind that kind of vision, that strategy, and then we all go and execute from there.
On that point, as you think about the business and how you serve the wealth channel, do you find that many investors in the wealth channel know you for one thing, and then once they know you for one thing, they start to know you for other things? So is it direct lending, or is it based on megatrends? How do you think about communicating the capabilities of what you're doing, and how do firms in the wealth channel think about Blue Owl, and do they know you for something in particular?
It's a hard question to answer with like a very simple, because the wealth channel, as you know, is just so big. It is so diverse, and especially then when you start going outside the U.S. I mean, there is no one wealth channel, right? There are multiple channels in the U.S. alone. There are multiple business models, and then outside the U.S. you add to it. But if I was to give you like a simple answer, I'd say, and this is just really history more than anything, is we started our wealth business in the direct lending business. So if you were to go out and do a survey, I'd say most people know us for direct lending. And certainly 2 or 3 years ago, like that, I would have said that with absolute certainty. I think over time, over the last couple of years, and I think over time, what's accelerating is knowing us to be a private markets manager, not a one specific asset class manager, but knowing us for bringing differentiated, innovative solutions that deliver for their clients. And that is tied around a couple common things, which is big secular trends in a more resilient way, highly focused on income. And we're seeing that again, like I said, our flows this year on the evergreen side, which is the bulk of our wealth success, is more like 50-50 private credit and other strategies that we had. And 3 years ago, it was 80-20. And so I think people are starting to know us, more for that. And that's where I want to go.
How much is that market focused, and these are the investment opportunities that make sense at the time versus the way that you've thought about marketing and branding the types of investment capabilities you have?
I would say it's decidedly not market-led, because the growth has been largely in real assets, and a big part of that is in real estate. And the last couple of years of, more recently, it's starting to change with rates coming down, but more like real estate has not been in vogue. So private credit's actually been in vogue. And like I said, our flows have gone over the last 3 years from about $5 billion and change to over $14 billion in 25. So it's gone up a lot. But real assets has grown as a big, part of that. And it's decidedly not because we had market tailwinds behind us. The sentiment behind real estate, for example, has not been particularly strong. So I would attribute that diversification and growth to a lot of education, a lot of, I think, the innovative approach we took to the product structuring and bringing the strategy to market. And so that's where I think most of the attribution of success would be in.
I want to touch on education, because you said something that the last podcast was incredibly memorable. These 2 points were somewhat related. I think they've been very instructive in how, I think certainly I've thought about and approached what has gone on in the wealth channel over the last few years. So one is, this is a fantastic quote, so I'm going to say it again.
I'm worried because my memory is like, you kept the receipts, and I'm worried, but okay.
So you said something really important, which wealth managers would certainly understand, which is private markets are a percent of a percent of a percent of their portfolio, and therefore a percent of a percent of a percent of their time. So you have to be really thoughtful in how you educate. Education, you also said, was something that should be, in some respects, industry-led. It helps the entire industry if all firms educate. Every firm will educate in their own way. Since we last talked, you launched the Nest.
Yep.
As I think every firm should. They need to have their own education platform and their own perspectives. What would you say has evolved from an education perspective when it comes to the type of information you're trying to deliver to advisors? And what do advisors want to hear now versus what they did and wanted to hear 2 years ago?
Yeah. It's evolved a lot, and I think it's evolved largely for the positive. I would, in a couple different areas. So us and others in the space have really leveled up our games, and I think that's largely positive. No one's going to have 100% market share. There's going to be a small handful, or maybe two handfuls, of, in my opinion, of large private markets, focused managers. And it's healthy for the ecosystem. Clients want diversification, so to have multiple high-quality managers with different capabilities and geographical footprints, et cetera, but largely pushing up the rock up the same hill, which is just advocating for private markets, explaining how it works, how to think about portfolio construction. So I think, broadly speaking, the industry has leveled up. And I think that's helpful, because to hear it from just Blue Owl, but to hear it from other really high-quality firms who they have their own view, but we all kind of rhyme, because we all are seeing a lot of the same things. I think that's helpful. The second thing that's helpful is our partners, like the wealth platforms we work with, have also invested in it. So things like CIO views, model guidance, like all of these things have come and are continuing to come into play, which is helping clients think through, and this will get to my third point, it's evolved into more portfolio allocation. So just 2 or 3 years ago was more around, I would say, more product education, right? How does this product work? And it's a product by product, like education purchase decision. It is decidedly moving, and I think it'll continue to move in a very healthy way of implementation. Okay, now I understand private markets should be part of the solution. I don't want to go pick a product. I don't want to spend the time educating myself on one particular product. I would like help on just how to think about implementation And I think that's where the education has started to evolve and will continue to evolve in a big way.
Where do you think we are in the implementation journey of advisors? And I asked that question recognizing that, as you said earlier, I think we both agree that the wealth channel is not monolithic, that there's different types of advisors and clients, and they have different types of needs. But when I ask this question, what I'm trying to get at is, how are advisors thinking about implementing? How are they balancing themes such as customization versus scale? And how do you want to help them think about that?
Yeah. I mean, our model here and in many other places, really to meet them where they want to be met, right? Because it is not monolithic. There will decidedly be a group of advisors who want to make individual decisions for their clients. That's part of their value add proposition. They have the resources and the wherewithal to do it. And that exists and will continue to exist, and we want to meet them. Others will want to completely outsource it for one reason or another. And then there's everything in between in the spectrum. And so I'd say we're obviously 100% there in terms of clients can go and do it themselves and they can pick a total outsource. I think we're not there yet. I think where we've gotten to is, and I think the advisors and the clients, like there's such a wide range, like there's a giant opportunity set with all of them. But I think over here is where we haven't fully gotten to yet. I think the education is there or about to be there. It's the implementation yet. Like you can't actually, if I guide you to, okay, you should be in 10% private credit and 10% private real estate, and you should pick these 3 managers in each. It's not easy to actually do that. That's I think the next stage of it, which is like, we can guide you as an industry or your home office or CIO, but if you can't act on that guidance, and that's really where I think the next leg of this will come, it becomes that's the next hurdle that we all have to jump over.
What's the missing piece of the puzzle right now in implementation?
I think it's largely technology, product innovation as not fully, what I would call a tradable model. Like you can't go buy a tradable private model with either private markets in it or just a private markets only, like yet. That is going to come. It may come in a variety of different formats. Who's making the decisions on those models still needs to be thought through. Is it a private markets only model? Is it private markets and public markets? Like all of those things it's decidedly not been solved yet. There's many people, including us, trying to experiment and trying to figure that out. But I think once that gets solved, that will open up people who are interested in private markets and get it, but are just unwilling to just make it a decision by decision, manager by manager, fund by fund.
That's where I wanted to go next, because I think there's a lot of really interesting nuances to unpack in what you just said, which is, how do advisors and clients want to purchase private markets products and have them in their portfolio? Do you think that things like models will be for a specific advisor population and a specific type of end client? Or do you think that it doesn't necessarily matter whether it's an ultra high net worth client or a mass affluent client, that will still actually end up having a similar product, at least for certain parts of their portfolio, just because maybe the experience, maybe the certain type of product or strategy makes sense in a model. Maybe it's just a core allocation, and then like an ultra high net worth client might be doing drawdown closed end funds as a satellite. But do you see a lot of uniformity in how different clients within the wealth channel will ultimately have exposure to private markets, or do you think that'll be very different?
I think it'll be more customized, is my guess. And I think for a couple of reasons. I think one, there's just the natural or the sort of regulatory legal requirement of like suitability, right? Like, I mean, we should call it what it is. Like they are less liquid by nature. And so you are getting advantages from trading off liquidity. But to say that one client who's, super high net worth versus a mass affluent, like they just shouldn't have, their time horizon, like all the things that their financial advisor will work with them on suitability and their risk tolerance and all of that. So you're going to have just natural customization to meet the clients, like just actual needs and circumstances. I also think then it becomes a little bit more of a personal decision. So we see it now. Very big, sophisticated clients don't want to do the individual decision either. And you'd be like, they're very large, very wealthy, very sophisticated, and they'd prefer just to outsource the decision making to somebody else who they trust and just create it for them. We have very small clients in, relative to the firm, but like they're making big investment on their own behalf and they're digging in. And it's because they think they understand it, because they have familiarity with the business model or, whatever the case may be. And that's their preference. So I think you're going to have to be able to customize this for clients, because at least that's what they're telling us that they want to do. There's a limit to how far you can go with that, but I do think there's going to be customization. We're seeing that now, sort of advisor by advisor. Some of them are creating their own models today based on their own views, which is fair.
How does that desire for customization drive how you think about product structuring and product creation?
I think we've been pretty good on the product structuring side and thinking through all the various use cases. So I feel pretty good actually about where we are, which is we work backwards. Ultimately, you have to work backwards from like, who's the end market, who's the end client, and is this good for them? And is this good for them? You have to ask that in a variety of different ways. Of course, is this investment strategy good for them? Does it work? Does it fit the wrapper, the structure, et cetera? And then does it work in the use cases, right? So like, how will it work operationally? What is the client experience? I'll ask this question all the time. We're thinking about new things we're doing. It's like, all right, so if I give you $100, like, tell me what happens to it. Give you $100, when do I get my money back, and how and over what time period? You have to think about that. And then how does that apply to all the different ways people can buy it? Because the model is ultimately just a buy, right? You're just buying it, like you're buying the model's buying it from us. And I think most of our products have that ability to do that. They are priced in a way, they're valued in a way, they transact in a certain way where they can fit into a lot of those things. And increasingly, we are thinking about that across not just models, but I'm sure we'll talk about like things like retirement. Like you have to structure them to have the utility to be able, and that's a lot of what we've been doing, is try to build not 100 different things, but a small handful of things that have a lot of utility that can be used across these different kind of, different ways that people want to ultimately express their exposure.
Do you think that the way in which the wealth management market structure is changing? What I mean by that is you're starting to see more centralization at some of the large independent wealth platforms. There's been a raft of OCIO acquisitions. So a few, just to share the example, Hightower NEPC, Cerity Agility, Pathstone Hall. Are those types of things changing the way in which a GP may interact with an advisor platform or the independent wealth community more broadly?
It is changing it for that cohort, but it is not a new phenomenon for us writ large. And so I think it's quite interesting. We work with lots of firms that that rhyme with those, and for a while they were all independent, and there were independent decision makers, and they had really fantastic businesses, and obviously this roll up and this centralization has changed it. Now they look, in terms of like how we cover them, we definitely have to evolve, right? But it looks a lot like a private bank or a wirehouse who has a centralized decision maker. They want to make sure that they get the most efficiency, they can use their size to get best pricing and best access and co-invest and all those things. So there's a real analog over here, which is there are other big consolidated wealth platforms where there's some centralization, and they use that centralization to their advantage. And you do have to cover them in a different way than a highly fragmented, highly dispersed decision-making group. So we're, I think, very well set up to do it. We've had to kind of learn from, this team to help with this team. And there's still nuances into how they operate and things like that. But I don't think it's not a meaningful change in terms of how we think about it, because we already have that muscle memory elsewhere in the organization.
It seems like that actually might be a positive development for the adoption of private markets within the wealth channel, because in some senses, these are partnerships between GP and wealth platform, whether it's wirehouse, private bank, or independent. But it makes it easier for you to be able to partner with them and ultimately distribute product.
It's more efficient for us. You still have to have that relationship with the advisor to make sure that they understand and have all the resources that they need. But it creates the dynamic you have elsewhere in the wealth space, which is shelf space is more finite, right? So one of in the independent RIA and financial advisor community, it's open architecture to the fullest degree, so they can decide to do whatever they want. Some of this consolidation, and everyone's taking a slightly different approach to this, but it does then create shelf space. So again, I think we will benefit, and some of our peers that look like us, we will benefit from that because those groups want to do more with less. They want to use their scale to get better access and better pricing and things like that, and we're very well suited to do that. But so it's more efficient, but then you have a different competitive dynamic than you would have otherwise in the independent financial. So there's puts and takes to it, I guess.
So we'll go from that's largely a US wealth management market structure to other parts of the world where Europe, you have a big presence. You've talked about the big opportunities there, a number of the megatrends. I think like you look at one of your investor day presentations as of, I think, this summer, and to put a pin on triple net lease, like the $11 trillion market opportunity is the same in the US as it is in Europe, and yet that's untapped or undertapped. So Europe, you've built out a presence, you've hired a head of wealth there. Asia, you have a head of wealth in Japan, a head of wealth in Australia, in addition to Asia more broadly. How have you thought about the international expansion of the wealth business and serving clients with different wealth management market structures?
Yeah. So this is another area, back to the original question around what's been driving, like diversification, also geography. So I think our exposure in the wealth space 4 or 5 years ago was essentially 100% US, and it's the biggest market and still our biggest market. But now it's down to 80%. So we've seen, and the growth in the non-US, and that's the non-US market has grown faster than an already growing US market for us. Our approach is we have a general kind of like playbook in terms of things that we go to, which is we're very slow to enter a market because we study it very deeply. We want to understand like how we can add value to the client. Again, the North Star is always like the best business model for us is, are we adding value to the client? If we're adding value to the client, everything else in between like will work over the long haul. And if we're not, then it's not going to work. So how do we add value to the client? Do our strategies work? Okay, well then how can we deliver them? What's their business model? So the markets you mentioned are very different even from themselves. And then how do we take what we do, but then conform and add local expertise, culture, language, familiarity with their business model? Just because we do it in New York doesn't mean it works in Toronto or Tokyo or Sydney or wherever. And then what I found is if we take our time, and we've decidedly built it organically everywhere we've went, takes a little bit of time, but once we get figured out, we move much faster. So the first one takes a while, like the first new geography took a while, the first fund took a while, and then it speeds up. And we're seeing that across the world where, it's worked. In many cases, it's our direct lending business because that's just where we started in wealth. But the adoption of things like triple net lease, asset-based finance, digital infrastructure, it's coming much faster. And so it's been a lot of just really studying it, learning it, and getting local expertise and not assuming that we know better just because we've had success in the US doing it one way and conforming to them.
How hard is it to build the brand internationally? And what have you had to do differently for the brand to resonate?
We've been building a brand all 10 years I've been here. So that it's a little bit, it's hard. I mean, of course, it's very hard. One of the things we don't benefit from is, we don't have big investment teams in some of these markets, right? We're not in private credit in Japan. We're not in real estate. We're just starting to build in Europe. So we don't have a lot of kind of decades of investing in the markets. So in many cases, we're the first or one of the first to come into these markets. So we're building it, we're building it from the bottoms up. So it's difficult, but I'd say we have a playbook, which is we try to anchor with the biggest partners. And in almost every market, we've been able to work with the biggest partners in those. That builds you credibility. We lean in very, very hard on resources and availability to explain our business. We put in the time and effort. We travel, we're talking about this, off air, like a lot, to be there and explain it. We hire good people, and then it grows, from there. And so that's the ground game. We've invested more recently in things like tennis, right? Where we've done, these challenger brands, and that's really helped in some of the markets. And it's been a cool way for our clients to engage. Where possible, we get lots of data. So some markets, we have lots of information about the market ecosystem. And so we can be very targeted in terms of like our brand building around like LinkedIn and some other things. And so it'll depend on the market, but we we try to go in a little guerrilla style and build it up. And I think, now our business has gotten to the point where it's not so like, oh, who are you? But earlier on, it was much harder, I can assure you.
Do you still consider yourself a challenger brand?
I always do. I mean, when I was here, there was six or seven of us and no AUM. And so if every day that's like the way I'm wired, I think we will have to evolve. We are evolving where we're not the startup that I think in my mind. It's kind of like I look at my kids and I'm like, you're a baby when they're not a baby anymore. So I think part of that is just my own bias, but I think it's healthy. Like I think part of our success is like we are very entrepreneurial, and I think it's very driven by a underdog type mentality, and I think that's a good thing for us to keep. And I want to I think it's a skill that we have, and I think it's a valuable skill that we want to keep.
I think you're hitting on something that is true for any company, even as they scale. You think about this certainly in the tech world. There are still companies that are market leaders, public companies growing in size and scale, but they've managed to maintain that startup culture, or at least have tried to. How do you think about preserving that type of entrepreneurial underdog culture even as you scale?
It's one of the main things I think about, just kind of how you preserve that culture, because at the end of the day, culture is, culture was the culture eats strategy for lunch. Like the culture is everything here for our industry and for our business. I think it starts with a couple different things. I would say one, the continuity of our team, across the whole firm, particularly across leadership, has been pretty remarkable. Like it's the same, group of people that are here, and and we believe it, and we buy it. I think the second is I personally, view it this way, and I know my partners do. We've supplemented that with an acknowledgement that what got us here is not going to get us to where we want to go. And so we've reinvented ourselves, certainly in wealth, a few times, where you have to bring in people that have done it at the scale where we're trying to do it now. I can assure you the way we were selling 7 years ago versus just now, it's remarkably different. And it's not because I changed everything I did. It's we hired really good people that knew what they're doing, but then you empower them. That's been the key, is hiring people that have skills to get you where you're going, empower them to make decisions. Usually they're coming from bigger firms where they are not as empowered because of just the structure of those bigger organizations. And then also teaching them hey, have you thought about it this way? Have you thought about kind of imparting the entrepreneur? So it's kind of melding the old world and the new world, so to speak, together. I think we've done that reasonably well, and we've made some good hires along the way. And if you get it right, you get all the skills that they have to run a much more complicated, bigger business than we have. And then they get really enthusiastic about it. And if you marry that together, we've seen it happen in our business. And so we just want to keep doing more of that.
Where do you think the growth areas are in the wealth business? Because you've added different pieces of the puzzle. You acquired Kuvar. You've hired someone specifically focused on the DC side. How do you think about the evolution of the wealth business itself?
Yeah. The good news is there's a lot of growth opportunities really throughout the business. I think a lot of the opportunities are in execution right now, and not in needing things to break our way, which is helpful. And what I mean by that is, just this last year alone, we've essentially doubled the amount of strategies we had. We had direct lending and we had triple net lease. Now we have direct lending, triple net lease, asset-based finance, and digital infrastructure. And we think about sort of the food groups that most people think about private markets. We have infrastructure, real estate, and credit. We don't have evergreen private equity because we don't have a traditional private equity business. But 2 years ago, we only had one of those, and now we have 3 legs of the stool. So I think that gives us the foundation to go much deeper with our clients. So we have growth opportunities in the US. Most of our clients, the platforms will tell you, their clients are still somewhere in the neighborhood of 20% cash. In the US, give or take 18, 23, I hear generally somewhere in the 20% cash. You marry that with the allocation to private markets, which is still in that low single digit percentage, there's a big opportunity for people to improve their outcomes by looking at private markets. So how do we do that? We can do that through adding new products, and then you overlay that with things like models and the rest. So I think there's just an opportunity to go deeper in the US with our broader product suite, with our more technology around models, the more portfolio implementation, and you multiply those percentages by the size of the US market. It's huge. there is growth outside the US, right? We are active, as you mentioned, and we're in Canada, we're in parts of Europe, Asia, Australia, Latin America. Those are a couple years behind where we're in the US, and we're seeing all of those same themes, though, in terms of education, product adoption, like that flywheel is starting to turn. So then that's, in my opinion, largely all execution. We've got, for the most part, the team on the field that we need, and they're excellent. We've got the product set, we've got the performance and the track record. And so execution there, is great. And that's before you think about things like retirement, right? Like the new frontiers that are harder to underwrite in terms of growth, but are very exciting nonetheless.
Is something like retirement, is that going to be as big of a driver of industry and AUM growth for alts managers as it might seem? Like 12 trillion as the headline number, but then only a portion will go into private markets. And then, so how big is that opportunity? And obviously the regulatory environment has to portend to adoption of the right product structures in the right places. But is that a very large opportunity today, or is that something in 5 years? And how large is that opportunity?
Yeah, well, you framed it right. My answer back to you would be over what time period I think is a really important, I think over a extended time period, and I don't know if that's 5 or 10 years, I think the answer is decidedly, it's a massive opportunity because the 12, 14, whatever the size of the market is, it's at zero today. And so any percentage times that is very significant for the industry. And so there is a big opportunity. The open question is, what is the road to get there? I would just share 2 observations. I think one is, I think it's important to understand it's not like you're opening up a new market. We are, but I don't view it that way. I think it's more as bringing a market like up to like today. Because if you think about retirement, 401k is just really a third of retirement. You've got 401k, which is defined contribution. You've got IRAs, which is defined contribution that you just rolled over to, your custodian. And then you got defined benefit, so, pensions and the like. Defined benefit, IRA, and 401k defined contribution are largely the same size, give or take. I mean, 2 of the 3 have access to private markets. And I think the craziest one of them all is, so if you work at Blue Owl today, you can't, we're working on this to be clear, but you can't buy private markets. If I leave Blue Owl tomorrow, I'm not, I love it here, and you roll your 401k over to your IRA, I can buy it. That doesn't make a ton of sense to me, and I think to the industry. And so a lot of this is, you're shutting out a huge part, a third of the retirement ecosystem from what the other 2/3 have had access to. So a big part of this is just bringing the ecosystem parity in terms of opportunity set. It's going to take, it looks a lot like the wealth business, in my opinion, when we started this 10 years ago. Very large, very low penetration, going to need a lot of education, a lot of product innovation, throw a lot of resources at it. And, in our experience, it took us years and years to see the fruits of that labor, but it worked, and now it looks smart, and a lot of people obviously are in the wealth space now. And my guess is it's going to be something similar, which is it's going to take regulatory change. It took regulatory change for us to launch our first BDC. It's going to take education. We've had to do that. It's going to take resources. It's going to take time. And all of those are rhyming. It's the history, it doesn't repeat, but it rhymes. This appears to be something similar. But it's too big of an opportunity, I think, to not work. And at the end of the day, it's good for the client. And if it's good for the client, smart people will figure this out.
So on that point, there were two elements of this that I wanted to touch on. One is pension plans. It's a different construct. There's a reason why that constituent has had access to private markets and DC plans have not. But investors have already, or real money, I should say, most individuals, or at least individuals who are part of a pension plan, they've had access to private markets. So it's, in some senses, it's actually not terribly new. They've had access in a different way, but they've had access. So I think that's worth noting. The other thing I want to touch on, because I think this dovetails well with how you think about the way in which you've built the platform at Blue Owl and what you invest in and what you stand for from an investment perspective, is the long-dated nature of these retirement accounts or product structures effectively would seem to fit very well with, you discuss the concept of megatrends, like financing digital infrastructure, financing the growth of private businesses, direct lending, private credit. Those would seem to go well in a structure that is long dated.
Yeah, strong agree. And I didn't even mention that. There is that element of like when you think about just the asset liability matching. Okay, and maybe just to go to your first point, to be clear, I think adding it into 401k, no one is advocating for like just open the gates in Wild West. Like it's in defined benefit in a very thoughtful way. It's in wealth in a very thoughtful way. There's financial experts that are helping. There's guardrails. All of those things are going to need to happen. And if that happens, and I think we're all aligned for it to happen in a thoughtful way, you're going to benefit from it, right? If you're going to match up very long dated capital, if you're 40 years old and you intend to retire when you're 60, 65 years old, why wouldn't you, in digital infrastructure, take AA hyperscaler credit risk? You're not going to make that type of return on a AA liquid bond. But you don't need that money for 25 years. You actually can't really get it. It doesn't need to be all of your portfolio, but if it's a very small part, that's meaningful. And that adds huge value to your financial outcome as a person. And so I think a lot of our asset classes fit very well because they are still downside protection in nature. They are income oriented. They're taking advantage of, kind of longer dated capital and longer investment horizons. And those things to match up pretty well with how people think about retirement writ large. And that's why I think we're going to be a meaningful additive to that ecosystem.
So what some might say is the headlines talk about private credit or the growth in data centers due to the AI boom. I want to make sure we touch on some of the notions of what you're hearing on the ground relative to what is being said often. Let's do private credit and then digital infrastructure or data center investing. What are you hearing from the wealth channel when it comes to their perspective on private credit?
Yeah, I would categorize it as, I think others have said this as well, as sort of signal through the noise kind of a thing. So the vast majority of our clients in our direct, and really when I say private credit, it's really direct lending, right? Is where I think most of the questions come from. Our clients buy it as an all-weather solution for their portfolio. They are looking at this really to be a low single digit, mid single digit allocation, not just to us, but to others, that generates a premium spread relative to what they can otherwise get in the public markets. And so it's done that. It's done that through COVID. It's done that through Silicon Valley Bank. It's done that through tariffs. I mean, it's done that consistently. You go back, GFC, it's done that. Like it's added value to the portfolios. And the vast majority of our clients look at it and say, yeah, this is working as intended. The growth in private credit and direct lending in particular, there's good reasons. Many people have talked about them. So I need to get into them now. Is obviously now attracted people writing about it that don't fully appreciate like the nuances and exactly how it works, and why it's good. But I think our clients do, because our clients have spent a lot of time understanding it, both on the institutional and the wealth side. And they're quite happy because they perform well and the portfolios are senior secured. They are largely, going below default rates, below loss rates of the public market equivalents, and they've worked as designed and are well positioned to do that. And so I'd say there are definitely more questions because articles generate, questions, and we're here to service our clients. But by and large, people are happy with what it's done, and they understand that it is a spread-based relative value proposition for a long period of time.
How does the current market structure in private equity more broadly, because some of the direct lending, not all, but some is sponsor backed.
Yep.
How has the lack of exits, the company staying private longer, how has that impacted the direct lending ecosystem?
It's been a bit of a push and pull, I would say. Look, on the negative this year, and we're not the only ones saying it is, and it was last year too, the lack of M&A, relative to historical averages has made it harder to source, right? And so there's just less deal flow that's been out there the last couple of years. And so that has made it decidedly harder on the direct lending industry. But I also think, and I think we'll see this over time, it is going to make it much clearer dispersion. Did you have the ability to originate? Origination, is not easy. It is hard. We have a lot of people. Do you have the ability to underwrite? Do you have the ability to portfolio manage? Like, do you have the real resources it takes when the market's not just giving you what you want? You have to go out and find it and structure it and do it in the right way. And so I'd say the lack of M&A over the last couple of years, or the slower M&A, has made it decidedly harder. But I also think it's an opportunity to showcase us and a few others the differentiation. If you are a small manager with a small amount of capital and a small team, it was much, much harder than to go up against the type of resources that we have. That seems to be changing, though. It feels like that's that, and so I think 26 looks like it'll be a much better opportunity for us. But staying private longer is actually, as a general matter, is actually a positive thing. And I think this is where, there are just more companies that are private than public. That's the whole pitch really around private markets writ large, which is the public markets as a total quantum of investable opportunities in terms of number of companies is shrinking. And it is extremely concentrated in 7 names. And so the number of opportunities for us continues to grow. And that's a good thing for us, as a broader proposition. And it is the reason people are looking at it, because they want that diversification within their portfolio.
It's interesting to observe flows from the wealth channel, particularly in private credit, and it still feels, I'm going off of a iCapital Alternatives Decoded, their most recent release of that, where it actually shows direct lending is a large portion of the flows from the wealth channel. On their platform, I imagine if that's the case there, that's probably the case on other platforms, and more broadly within the wealth channel. How has the influx of capital made firms think about underwriting? There are probably only a certain amount of firms that actually have the ability to originate enough size and scale to support the amount of capital they're taking in. So how are firms managing that aspect of private credit? And then how do you think about the space continuing to grow and being thoughtful about the amount of capital that's coming into funds relative to what it is deployed into?
Yeah. So I think when you look at the flows, there's about 4 or 5, maybe 6 firms that garner by far the lion's share. We're one of them. Those are the same firms who are the 5 or 6 large players in direct lending. And that's where we operate. And so I think you have to kind of decode a little bit of this. Is just because you have a private credit fund or a non-traded BDC doesn't mean you're competing with, what I would classify as the very large peer set, which includes us. The typical company for us is 250, 300 million of EBITDA. That's a really big business. That's a $2-3 billion business, which means their financing needs are somewhere in the tune of $1 billion to $1.5 billion on average. Part of the proposition of direct lending is providing the capital. If you are not big enough to provide that capital, you may be able to get access to the deal later on, but you are not driving outcomes. You're not driving underwriting. And so what we've observed is more capital has definitely come in. The business has grown. It has continued to take market share. Direct lending as a percentage of sponsor-backed finance continues to be at a relatively high level, and we are taking market share. But the number of firms we compete against hasn't changed dramatically. It's 4, 5, 6 firms, and that was true 7 years ago, just like it's true today. We're all just bigger. And so it's not like there's 700 of them or 7,000 like there are in the private equity space where there are thousands. It's still the same cohort. And what we've observed is they're doing what we're doing, which is at the end of the day, credit quality drives performance. We don't see people making bad, crazy judgments on underwriting, on things like that. And I can only speak to where we are in the upper market, where it's a smaller competitive landscape, and people have their own biases and preferences, and they, just like we do. But we haven't observed the peer set, because we sometimes work together with them, doing crazy things. It's very smart things, and they're very, thoughtfully underwriting companies. And so we haven't observed any of that. And I think that's helpful and good for the ecosystem.
Well, one place where my mind goes connecting the dots between two things you said. One is private companies staying private longer, and two, the TAM of direct lending expanding as a result. Like, one, you have more traditional companies and traditional industries that are of size and scale that private is now financing, and they're almost kind of like investment grade effectively. But two is you have technology companies that are large in scale. So Databricks, I believe, was one of the deals that you financed. And that's a huge company at this point that is also growing at, I believe, like 50-60% a year top line. That's type of business that I imagine only certain firms would have the ability to access given the size and scale.
Yeah, table stake where we operate, table stakes are you need to be able to write and hold for $1 billion. And there are very few firms that can do that. That is what gets you access to the opportunities. That's what gets you the early looks. That gets you the connectivity with the management team. That gets you access to the diligence. You're in the room driving documentation and part of that, helping shape that. And that's all the value proposition of direct lending. And those are the type of companies we like to finance. Very big, very market leading, very recession resistant, very stable annuity-like revenue streams. And there is a very large TAM, for that ecosystem. And so competition will ebb and flow. Our biggest competition, we talk about this, I think, is really the public markets. Public markets are where, that's really where most of the competition is can they go take a different solution, which has its own set of pros and cons, but is available to most of these companies if the market's open. And that will ebb and flow. There have been years where the golden age of private credit, where that market was not available, so we got 100% market share. There's times when it's available and very attractive, and we'll have to compete more. But the key is stick to your knitting on underwriting, right? And that's what we've observed in our portfolios is defaults, losses, watch lists. Things haven't changed in terms of quantum, and they've been moderate, and that's delivered good performance.
I think that's a good transition to the digital infrastructure side, because I think there's probably some nuances to unpack with how you think about that. You mentioned earlier, you take underwriting risk on a AA, single A company, not necessarily the data center itself. I'd love for you to unpack that, because I think that nuance is an important one when thinking about what is the opportunity in digital infrastructure and how do you think about financing that?
Yeah. So there's a couple ways to unpack this. I would say the opportunity, most people intuitively understand what's driving the opportunity, but just to say it out loud, actually, the first part is actually not as intuitive. I found cloud computing is huge, right? So if you look at our data center business, our digital infrastructure business, it's been building, managing hyperscale data centers or data centers for hyperscalers for cloud for over a decade. We're one of the largest players there. We've got over 100 of them. They're around the world. And we built that business with the hyperscalers because they had that need.
So that was pre-AI.
Pre-AI, right? And so we've already been doing this for a long period of time. AI has come since and added another level of growth. But cloud computing, which is a proven business model, one of the most profitable parts of the big data center, or technology companies, is still growing 20-30% a year. And you travel anywhere around the world, and almost every single company will tell you they don't have enough cloud computing power to do what they want to do today. Like, they're turning customers away. That's driving growth. Then AI obviously adds a whole other level of growth. So we sort of call it a wave on a wave. AI gets all the attention. Cloud is the more obviously proven, and it's a giant part of the business. The opportunity set, you look at the CapEx needs to meet what all these companies want to do, the supply-demand imbalance is extraordinary. The demand for capital is far, far, far outstrips the supply by hundreds and hundreds and hundreds of billions of dollars. That's a great opportunity set. So we have a team that's been doing it. We have over 1,000 people in our digital infrastructure management business. We've got 100 data centers around the world. You've got this giant supply-demand imbalance, and then you throw AI on top of it, and it's a really sort of generational opportunity. I think where a lot of the questions come from is this whole AI bubble notion. And I will borrow, the CEO of Anthropic said this recently in a conference where he said, look, you have to separate this into two areas. the technology. Like, does it pencil out? Does it work? And is it going to be here? And I haven't found anybody that disagrees with that. Maybe you do, but like, I mean, most people think it is here, it is coming. It's a question of economics. How do you invest? And I think the economic question is what people are talking about the bubble, which is to say, what risk do you want to take and what reward are you going to get for that risk? What we do is we are not trying to figure out what's the right AI business model. That's just not, we're not good at that. We'll never be good at that. People will make lots of money doing that. Some people will lose lots of money doing that. There's a big transformation there, but better people are better served to do that. We want to support the thing people know is there and will be there for a long period of time. And the way we do that is we build data centers or we own data centers. And if we're building new ones, we're doing it with a lease, and we're doing it with a very long lease that is very strong in our favor, that essentially gives us a minimum amount of return because it's a 15, 20-year lease on one of these hyperscalers who are the best credits in the world. So that's what we're trying to take. We're not trying to pick which chip is going to work. We're not trying to pick which AI model is going to work. We are trying to pick the best companies with the best credit profile and help them go figure that out themselves.
What are the questions of most concern that you're getting from allocators in the wealth channel when they're asking about the risks that this investment strategy might have?
One of them is just that, is AI a bubble? Like, and so hopefully I addressed that, but I think it's hard to know which, is it ChatGPT? Is it Gemini? Is it like, which one of these will work? And at what price is it worth investing in? So I think that's a very fair question. And I think it's more just, well, we own the four walls and the power that help all of these work. The second is, okay, well, like, but what about if the data centers are obsolete? Like, residual value risk, obsolescence risk. We don't want to take that risk either. And so when you look at the way we underwrite our deals, like I said, they're 15, 20-year leases. And if they are shorter, they have mechanisms that effectually get you back to 15 to 20 years of contractual payments. So where you're taking a hyperscaler risk, you are making a high single-digit, low double-digit return just on the quality of their credit. That's what we're doing. So people are asking, like, well, what if the data center is not worth anything? Well, if worst case scenario, we made you a 9 to 12% return over a 15, 20-year period on a AA credit, like, I'd sign up for that all day long. We still think that they will be worth something in the future because there's a lot of utility for these, and computing is not going away in the future. But if you think about it in the worst case scenario, you've got really the best credits on earth backing a very long dated cash flow, making you very above average returns. Like, that seems to be a good investment. And just to hit the residual value, we own the data center that supported the dial-up for AOL, right? Like I remember that. Like you like the screeching and the beeping. Like, that data center doesn't use that technology anymore, obviously, but the data center is used by a hyperscaler today on a long dated lease because it has the power, has the proximity to the clients, it's got the everything you need, and they just change what's inside. So we're doing the outside. We're not taking the risk of what's changing on the inside.
So if a hyperscaler were to say, I don't find value from using a data center for AI, they might still use it for something else. Or even if they were to walk away, you'd still be able to find a way to create value out of that data center.
I think it's a little bit different than that, which is, say, first, it would be like them saying, you know what, I don't want to pay that bond anymore. Like, any one of them has bonds that trade there. In theory, they could say, you know what, I don't want to pay that anymore. That has ramifications, right? And so we're getting to that. It's a contractual obligation. It is a long-dated contractual obligation. And like anybody, you expect to live up to your contract. That's how we structure them.
So is the way to unpack your answer that you're not really taking AI risk?
We are taking the credit risk of the counterparty, which are big, diversified, highly profitable, mega technology businesses.
What's your biggest worry with some of these mega trends as you think about creating the right investment strategies and products in areas like digital infrastructure or direct lending?
I'd say it's a worry, but I'd just say like the focus, right? Again, our whole model is focus on protecting the downside, right? Like what we're trying to do is deliver a reasonable level of return, limited volatility, relative to the public market equivalent, and that all comes down to discipline. I think we have a very long, demonstrable track record of doing that, but that's just the forever thing you have to be focused on: is, are we looking around the corner? What's the downside risk of this credit? What's going to impact that business? And have we thought through it? We're never going to be perfect, but that forever concern, like that's how our business is built, is to be always worried about what can go wrong, and keeping that perpetually in our DNA is what I think will deliver value. So to me, it's not so much a worry, but it's more we always have to be worried, so to speak, because that's the model. Like, worried about what can go wrong, and if we do that consistently and in a very thoughtful way and add the right resources, which we have and will continue to do, the rest does take care of itself.
So the other way of looking at that question is, what are the next things that you want to be able to provide solutions for when it comes to helping the wealth channel and institutional channel as well? You have a threaded theme or way of investing, as you just described, but are there certain types of strategies that you feel should come next in what particularly the wealth channel might want to invest in?
Yes, but I would say right now, like, there are a few that we have in mind. I would say they're probably not like immediately on the come. I think it's more, like I mentioned earlier, the asset-based finance and the digital infrastructure, we really just brought them to wealth in the last 6 months, right? So we've had a lot of early success in getting those going, but it's more around really going out and educating people about how that can add value to the portfolio. So I'd say our focus is more on taking those capabilities that we have a lot of conviction in, we've got big capabilities in, and bringing those to market. It's more around that execution piece, while we think through what the next big thing could be.
What are you most excited about when it comes to the next big thing, private markets and private wealth?
The list is too long, but I'd say the combination of the market moving more towards portfolio implementation as opposed to individual fund is a monumental, and it's not just like the thinking, but the technology behind it and a lot of like the guidance, the implementation. Like, I think that's a really monumental shift, the opportunity to be a very monumental shift, which will help lots and lots of people think through how to do this and do it in a thoughtful way. Coupled with, we have a meaningful say in almost all parts of that. So like, I'm excited about where we're positioned, because I think we're positioned in those big secular investable trends, but we're also positioned in those kind of core food groups that really help drive that next level of adoption. And that's a whole other kind of leg up for our business that we have really across the world.
Well, since the last time you were on, you've grown almost 2x. AGM has also grown a lot, to answer your question. I've grown from a smaller base, but it's been closer to 5x on the subscriber side since you were last on. But you also have almost $300 billion. So it's harder to go from $300 to $600 billion. But I'm curious to see how things evolve over the next few years, because it feels like there's a lot of just getting more advisors into private markets and more clients into private markets. There's increasing allocations. There's adding new geographies. There's adding new types of investment constructs like DC plans. But as you've said this, you're a growth company in a growth industry investing in growth trends. That, I think, sums up a lot of our discussion, because it just shows the different aspects of what you're doing, how you're doing it, and how you're threading that same core theme and DNA of how you invest through all of that. So, great conversation.
Great to be here. The next 2 years, we'll see where we're both at.
Love it.
All right. Thanks,
Thanks
Michael.
so much. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going